and the benefits of low and predictable inflation will be restored. Finally, we're trying to balance the risks of under and over tightening. La décision aujourd'hui reflète plusieurs considérations.
Premièrement, l'inflation au Canada reste the inflation in Canada remains high and generalized. It's reduced over the past few months, but we're still waiting for an overall depression on price. Second, the demand is still higher. The economy is overheating. Households and businesses want to buy more goods and services than the economy can produce, and that increases prices. Third, the interest rates, or high interest rates, are starting to weigh on growth. It's more and more evident in sensitive spending around interests like housing and large purchases, but we'll need time for the effects of these increased rates translate to the whole economy. Fourth, there are no easy solutions to restore stability, price stability. The economy must slow down to rebalance the offer and demand and reduce pressure on prices. Over the next quarter, growth should be close to zero, but after that slowdown, growth will redress. The economy will progress strongly, and Canada will once again benefit from low and predictable inflation. Finally, the bank is trying to balance out the risk of too low or too high tightening.
If we don't do enough, Canadians will continue to endure the hardship of high inflation. And they will come to expect persistently high inflation, which will require much higher interest rates and potentially a severe recession to control inflation. Nobody wants that. If we do too much, we could slow the economy more than needed. And we know that has harmful consequences for people's ability to service their debts, for their jobs, and for their businesses. This tightening phase will draw to a close. We are getting closer, but we're not there yet. We are carefully assessing the effects of higher interest rates on economic activity and inflation. And we are being clear with Canadians and focusing on the job we've been assigned, to restore price stability for the benefit of all. Let me expand on these considerations and highlight the key points in the Governing Council's deliberations. Le Conseil de direction a abordé
The Council has first of all evaluated the international situation since July. Inflation is high everywhere and is generalizing. Most central banks have increased their prime rate to control inflation, which caused a quick tightening of financial conditions throughout the world. The international economy is slowing down, and we've reevaluated our growth anticipation. So financial tensions have also emerged on certain markets over the past few months. Indicators seem to show that international problems will reduce. The price of oil and other basics have also gone down since July. The slower growth in the world combined to these evolutions tend to show that international inflation should go down over time. However, uncertainty is high, especially because of the Russian invasion of Ukraine. It's also possible that volatility will increase on the energy markets and the other problems will start up again.
Devoted considerable attention to assessing inflation, inflation expectations, and the balance between demand and supply in the economy. Since June, inflation in Canada has come down from 8.1% to 6.9%. Though welcome, most of that decline reflects a drop in gasoline prices. Inflation in Canada is broad-based, reflecting large increases in both goods and services prices. About two-thirds of CPI components have risen by more than 5% over the last year. And rising prices for essentials like groceries and rent are hitting lower-income Canadians particularly hard. Short-term movements in total CPI inflation are often dominated by swings in volatile international prices like oil prices. That's why we're watching measures of core inflation closely for signs that price pressures in Canada are easing. Our preferred core measures have stopped rising in the last couple of months, but they have yet to show clear evidence that underlying inflation is coming down. Looking ahead, there are some early encouraging signs. Businesses have said they expect the rate of price increases for the goods and services they sell will come down. And more timely, 3-month rates of core inflation have declined, although they are still averaging about 4%. We're going to need to see these 3-month rates come down further and those declines be sustained. We are also looking for evidence that near-term inflation expectations are easing and that longer-term expectations are centered on our 2% inflation target. Near-term expectations remain high, and our surveys suggest that uncertainty about where inflation is headed remains unusually elevated. Looking at indicators of labor markets and economic activity, it's clear that even though the economy has started to slow, it remains in excess demand. Job vacancies have declined from their peak, but remain high, and businesses continue to report widespread labor shortages. With the economy now fully reopened, households want to enjoy many close contact services they have missed, but businesses can't keep up, and we have seen prices for services rise rapidly. Higher policy rates are beginning to slow demand. Higher mortgage rates have contributed to a sharp slowing in housing activity from unsustainable levels, and consumer and business spending on goods is moderating. This has led to declines in house prices and is exerting downward pressure on goods prices. Moving forward, we expect the effects of higher interest rates will continue to work through the economy, moderating household spending and business investment. Slowing global growth, particularly in the United States, will also weigh on Canadian exports. We project GDP growth will stall through the end of this year and the first half of 2023 before picking up in the second half. Annual average GDP growth is therefore projected to decline from about 3.25% this year to just under 1% next year and about 2% in 2024. With growth below potential for several quarters, excess demand in the economy dissipates and the economy moves into excess supply in 2023. Putting the global and Canadian outlooks together, we expect inflation will hover around 7% in the final quarter of this year, fall to around 3% by the end of next year, and return to the 2% target by the end of 2024. The Bank
of Canada has as a mandate to maintain inflation at a low, stable, and predictable level. But we are still far from the goal. We judge that risks surrounding our inflation provisions are reasonably balanced, but since inflation is over the target, we're mostly worried about upside risk. We know that higher interest rates are hard for a lot of Canadians. Many households are very in debt, and increased rates comes and adds to the burden. We don't want this transition to be harder than necessary, but we are still determined to fill our mandate. Higher rates short-term will lower inflation long-term. We need to get through this difficult phase to come back to price stability and sustained growth.
The Bank of Canada's job is to ensure inflation is low, stable, and predictable. We are still far from that goal. We view the risks around our inflation forecast to be reasonably balanced, but with inflation so far above our target, we are particularly concerned about the upside risks. We are mindful that adjusting to higher interest rates is difficult for many Canadians. And many households have significant debt loads, and higher interest rates will add to their burden. We don't want this transition to be more difficult than it has to be, but we remain focused on our mandate. Higher interest rates in the short term will bring inflation down in the long term. And getting through this difficult phase will get us back to price stability and sustained growth. As we move forward, we'll be watching carefully to assess the impact of higher rates on spending and how this is feeding through to price pressures. We will also be watching to see how global supply disruptions resolve and to what extent this translates into lower inflation in Canada. Finally, we'll be watching inflation expectations closely to assess how households and businesses are responding to slower growth and spending. And with that, Senior Deputy Governor Rogers and I are pleased to take your questions.
Thank you, Governor Macklem. Just before we get going, if there are any reporters who have joined the call in the last few minutes and you want to ask a question, please send a brief email to communications with an S at bankofcanada.ca. We'll do our best to get you in the queue. That said, I've got at least 10 people here in the room and 3 on the line, so we'll need to be expeditious here. We'll go to questions now, starting here in Ottawa, and we'll go first to Mark Rendell of the Globe and Mail, please.
Hi, Governor Macklem. Thanks for taking my question. In the monetary policy report, you note it's as likely to see several quarters of negative growth as it is to see positive growth. Are you saying a recession is likely at this point, or a possibility at this point? And how is that, I guess, how have your assessments of a possible soft landing changed with the new update?
Mark, our mandate is clear. Our primary responsibility is to restore price stability. We have been raising interest rates rapidly to achieve that goal. And the other thing I would stress is by front-loading our policy response, we're trying to avoid the need for even bigger interest rates down the road and an even more pronounced slowing. As you mentioned, our latest outlook, we have growth stalling for the next several quarters. To be more precise, growth is close to zero in the fourth quarter of this year and the first 2 quarters, the first half of next year. What that does, what that means is that, yes, a couple, 2-3 quarters of slightly negative growth is just as likely as 2 or 3 quarters of slightly positive growth. That's not a severe contraction, but it is a significant slowing of the economy. And we certainly are seeing clearer signs that the economy is slowing. With growth essentially zero for the next several quarters, that will give supply the opportunity to catch up with demand, and that will relieve price pressures in our economy. Unfortunately, there's no easy out to restoring price stability. We actually need a period of slower growth to let supply catch up and relieve those price pressures. As we get through that period of slower growth, growth's going to pick up, economy's going to grow solidly, and we're going to have low inflation. So Canadians are not going to have to cope with the anxiety of high inflation.
Next up, we'll go to Raul from Epoch Times, please.
Thank you for taking my question. Given that the interest rate changes take 18 to 24 months to have full effect in the economy, basically, how will the Bank of Canada know when enough is enough? Like if you're looking at sort of backward-looking measures like currently reported inflation or even 3-month inflation trends, and given the embedded path of interest rate hikes that you have in the projection, we can see that inflation is supposed to get to 2% by the end of 2024. But is it all a model-driven thing that you will know when enough is enough, or it's kind of hard to say by looking at what measures are reported? So how can we get a better idea of when enough is enough in terms of interest rate hikes?
Okay, you packed a lot in there, but let me try to address your question. First of all, the way the transmission of monetary policy works is we raise interest rates, that slows spending, And then that translates into lower inflation. That relieves price pressure and inflation comes down. So we are going to be watching closely how the effects of higher interest rates work through the economy. And, first of all, how they're affecting spending. We're already seeing clear signs that the interest rate increases that we've already done are having an impact on the economy. You've seen certainly contributed to a sharp slowing in the housing sector. You're starting to see purchases of bigger ticket items, things that are typically bought on credit. You're starting to see demand for those things slow. You've already seen house prices come down about 10%. It is going to take, as you highlighted, it is going to take some time for the interest rate increases we've put in place to work through the economy. We're going to be assessing how that works through, and we're also going to be watching closely for how that gets translated into low inflation. With respect to, is this an entirely model-driven exercise? No, it's not. Models are very useful, but models have limitations, and they have particular limitations when you're going through something that is unprecedented as a pandemic, and you're bouncing back, and you're still dealing with the fallout of the pandemic. There's also a war in Europe, so these are not things that our models are well equipped to deal with. Models are certainly useful, but they need to be used with care. They also need to be supplemented with other kinds of information. So, for example, our Business Outlook survey, our surveys of consumers, they give another source of information. They can also be useful in giving more forward-looking information. One of the things I highlighted in the opening statement is when we went out and we asked businesses what they expect they're going to be doing with their own prices of the goods and services that they sell, they have indicated that the rate of increase of those prices they expect will come down. That is an encouraging sign. We're looking forward to seeing that in the actual inflation data.
Thank you. We'll go to Najoud El-Malis of Canadian Press, please.
Hi, Governor. Before today, markets were a little bit torn between 50 basis points, 75 basis points. The bank opted for the smaller one. And I'm wondering if you could shed some light about that decision and why you didn't opt for a larger rate hike.
So, as you said, we decided today to raise the policy rate by 50 basis points. That is another larger than normal step. It's a big step. And as I outlined in the opening statement, there were a number of reasons why a larger than normal step, a big step, was needed. Inflation's high, it's generalized. Even as the economy is slowing, it remains in excess demand, and that is driving prices up. The economy is slowing, but actually we need some slowing in the economy to relieve those price pressures. And if you look at inflation expectations, near-term inflation expectations are high, and there's a risk the longer they stay high, that starts to bleed into higher long-term inflation expectations, and then high inflation becomes embedded, and we can't let that happen. So for all those reasons, we needed we judged we needed a bigger than normal step. We are also seeing clearer evidence that the economy is slowing. As I just responded to a previous question, we have taken down our outlook for GDP growth in Canada. We expect growth will be close to zero for the next 3 quarters before picking up. What that will do is, with growth well below trend, that provides the opportunity for supply to catch up, and that will relieve price pressures. So coming back to 50 versus 75, at our previous 2 meetings, July and September, we increased by 100 and by 75. So coming into this meeting, interest rates were already considerably higher. You combine that with the fact that there are now clear signs that the economy is slowing, we judged that it was appropriate to slow the pace of increase in our policy rates from very big steps to a big step. Looking forward, we also indicated that we expect interest rates will need to rise further. So that suggests that, well, that could be another larger than normal step, or we may be able to move to more normal, smaller steps. We are getting closer to the end of this tightening phase, but we're not there yet.
Thank you. We'll go to Jordan from CTV, please.
Hi, Governor. Thanks for taking my question. The report says food and shelter inflation represents about 40% of the CPI. This especially affects low-income families. So what is your message to them today, given that you are signaling your tightening phase is not over yet?
The message to Canadians is, look, we know inflation's too high, and we know it's hitting you everywhere. It's hitting you shelter, rent, groceries. Roughly 2/3 of the components of the CPI basket, 2/3 of the things the average Canadian buy are going up more than 5%. That's hurting Canadians. That's why we're raising interest rates. By raising interest rates, we're going to slow demand in the economy, and that will relieve price pressures. We also know adjusting to higher interest rates is difficult for many Canadians. And we are assessing, we're watching that impact very closely. But unfortunately, there is no easy out to restoring price stability. We actually do need to slow the economy to relieve the price pressures. But when we get through this slowdown, growth's going to pick up, the economy is going to grow solidly, and we're going to have low and predictable inflation. That's the destination.
We'll go next to Paul Vieira from the Wall Street Journal, please.
Following up on previous question, is this a pivot from the Bank of Canada? Should we take this as maybe a pivot by the Bank of Canada that, as you said, very big or even big rate increases are now coming to an end, and we're going to have a return to more traditional quarter-point increases given the economic forecast?
Well, we did 100, we did 75, today we did 50. We've signaled very clearly that we expect rates will need to rise further. That could mean another bigger than normal increase. It could mean that we can move to more normal size 25 basis point increases. We've been very clear on the things we're watching as we take those decisions. And it's going to depend on how the effects of higher interest rates are feeding through to slowing demand. It's going to depend on what we see in inflation and inflation expectations. And to some extent, clearly, inflation is going to be affected by international developments and how those global supply chains disruptions resolve.
Thank you. Next question will be Heather Scoffield of the Toronto Star, please.
Morning. Governor, I'm wondering how you are assessing your credibility these days, and if that plays into your decision on rates at all. Do you have to raise rates any? Do you have to be more aggressive, I guess, now that in order to keep your credibility, now that you have politicians on all sides kind of questioning you?
Look, we need to do what we have to do. We have a very clear mandate. We're committed to achieving our mandate. We are trying to balance the risks on both sides. We don't want to under tighten. Inflation's not going to fade away by itself. And if we ignore the problem, if we're half-hearted in our response, inflation, Canadians will have to continue enduring high inflation. They'll have to continue to cope with the anxiety of high inflation. Nobody wants that. We're also very conscious, though, that if we over-tighten, the economy will slow more than is needed. That'll make life more difficult for Canadians than it's needed, and we'll undershoot our inflation target. So we don't want to do that either. These are difficult decisions. I will say that the independence of the central bank becomes more important when the decisions are difficult.
Prochaine question vient de Olivier.
Next question comes from Olivier Fernand-Boisé from TVA. Hello, Mr. Governor. Thank you for taking our question. You're saying that you want to balance the risk on both sides, but there are people who worried about having to bring the keys to their homes to the bank because they cannot not pay their mortgage. So how do you ensure that an additional increase isn't one too much? What are the indicators that show you that your approach isn't too aggressive? Yes, we are very aware that increased interest rates are hard, especially for Canadians who are in debt. Now, increased rates for mortgages has already had a marked effect on the housing market, and we now see that activity has lowered a lot and prices are also lower. Now, we're looking at these adjustments closely. We're very aware that adjusting to higher interest rates is hard for a lot of Canadians, but I want to mention and underline that the economy is exceeding demand. And the adjustments we see in the economy, and even the adjustments that we see.
We are listening right now to the Bank of Canada Governor Tiff Macklem taking questions from reporters after today's rate hike of 50 basis points. So that brings it up to 3.75% in this country. There is growing concern about the rate hikes, what they're going to mean for Canada and whether or not it will drag Canada into a recession. And we heard from Tiff Macklem off the top that there is this balance they're trying to strike between that risk of under and over tightening. He also said that the end is coming, but we're not there yet, and that there are some encouraging signs on the horizon, but we could be looking at 2024 before things start to stabilize.